can hear you. Yeah, I can
Yeah,
hear
yeah,
you.
yeah.
Yes, loud and clear. Good afternoon, everyone. My name is Antonio. I'm the founding partner of Venture. Venture is an early stage venture capital fund. We are now fundraising our second fund. We focus on four main verticals: energy, manufacturing, healthcare, and e-commerce, in companies anywhere in the world that have at least one Italian co-founder. Our focus is on early stage technologies, everything that has to do with tech and sustainability. Those are the enablers for the companies where we invest. Our first fund has 12 investments so far, an excellent performance, and as I said, we are now recently started fundraising for our second fund to keep growing and investing in these companies. I'm also I've been an angel investor in the UK. This is probably my 10th year as a part of the UK Angel Investor Network, and have a lot of active investments, some very successful, some others a little bit less. But always I am also mentoring different accelerators and incubators, and so I've been helping founders to grow their company in the past 10 years here in the UK. Thank you.
Thank you very much. I think we've got Dan after that. Dan, can you hear us? All right. Dan, I know why, because Dan is not a presenter. Because Dan has not joined with the same email address that we sent the invitation. Dan, can you hear us, buddy?
I can hear you loud and clear now. Thank you.
Go for it.
I'm Dan Ballin. I'm Chief Executive of Ideas Crucible. We capital raise for startups and scale-ups, particularly in deep tech, med tech, IP-rich areas, and regulated spaces, typically those that are going from a startup to scale-up stage, typically raising seed to Series A+ at the end of the day.
Thanks, Dan. I think it's Oscar and then Tommy, please.
Good afternoon, all. My name's Oscar. I've been at Edenred Capital for 3.5 years. Edenred Capital invests in B2B SaaS businesses in Europe, focused on 4 verticals. The first one is future of work, anything from employee benefits to mental health to frontline, to even kind of learning and learning management content. Our second vertical is around the EV transition. So as fleets move from internal combustion engine to EV and that value chain there. Our third vertical is fintech, but we have a specific interest in corporate payments. And our fourth vertical is commerce tech. We invest 500K to 5 million tickets and usually look for a board seat and are fairly operational in our approach.
Thank you very much, Oscar. And last but not least, Tommy, please.
Hi, my name's Tommy Breen and I'm a senior advisor at the Growth Stage. So the Growth Stage is a capital raising platform focused mainly on, as our very on the nose name gives away, businesses that are already in their growth stage. So, what that means really is we work with businesses typically when they're looking to raise a Series B round or later. So, call it looking to raise maybe $50 to $20 million right up to, into the hundreds of millions sometimes. And then outside of that, I'm also a mentor at Founder Institute. So I've got a lot of experience working with founders at much earlier stages of their businesses and trying to guide them through the first part of their journey from ideation to getting their MVP launch and then trying to find product market fit.
Thank you very much to you all 4 gentlemen. Really appreciated. Quick reminder, I see there's a few joiners. This is Startup Fundraising Q&A. We're doing this. It's our 142nd session. And as I do this reset of the room, perhaps the chaps on the panel might want to think of one do and one don't when it comes to early stage fundraising. So we're here to help founders with whatever questions you may have on your fundraising journey, whether you are seeking to raise now or perhaps you may need to do that later. The idea is quite simple. There literally are no wrong questions and there's no need to be shy. It's a learning curve for us all. You can ask about anything to do with your fundraising journey, whether that's investor outreach or pitch decks or data room or valuations or equity or due diligence, or maybe do you go for grants, angel VC, or corporate VC or crowdfunding or a loan, what are exits and all that jazz. They're literally, again, there are no wrong questions and there's no need to be shy. We are, however, going to run out of time in precisely 49 minutes from now. So my advice is not to leave it for last second. Otherwise, we won't have time to answer your question. For those of you that are tuning in via the live streams, whether it's LinkedIn, YouTube, Facebook, or Instagram, there is no point in sending messages or commenting there because unfortunately, we are unable to monitor your questions there live. So if you do want to join us, you'll have to do it here via Microsoft Teams. And that's where you can ask the questions. There are two ways you can do that. There are links on most of those live streams that you just click on them. But if for any reason they're not working, simply go to our website, startup2scaleup.club. Look for today's session, which is Startup Fundraising Q&A 142. You click join. It's a quick registration. That gets you a link to your email. You click on that link. You're then here on our audio only call. By the way, it's audio only so that we can give an opportunity to anybody, despite where you're based, to tune in and get some help from some really experienced people in this field. By the way, if your questions are not on fundraising, save them for the other events we run. Mondays is talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising. Second Friday of each month is UK Startup Legal, and third Friday of each month is UK Startup Finances. They're all from 12 to 1 p.m. UK time. And you can RSVP to any of them via our site, startup2scaleup.club. And actually, when you're there, you might also want to join our WhatsApp community. We've got some amazing groups of founders, investors, and operators. And there's a WhatsApp icon at the top and bottom of that site. Now, without further ado, let's hear some quick do's and don'ts. Let's not use the same challenge for both a do and a don't, please, gentlemen. So maybe we can start with Tommy, Oscar, Dan, and then Antonio, please.
Yeah, so one thing that is becoming more common now is, founders are going out, and I think there's always been founders always felt they need to go and raise money, and that's part of the startup journey. But I think, the way technology's developed over the last couple of years and how easy it is to build an MVP, I think it's really important that founders don't just assume they need capital and to actually sit down and work out why they think they need to go and raise even that first, 100, 200 grand. If they don't have an MVP out there, I mean, you can use AI coding agents now. You can just literally natural language prompt to build basic web app MVPs and get those testing. So, it really doesn't cost as much as it used to get an MVP out in the market. So I'd say before you even think about going to any investor or trying to identify who the right investors would be for your business, I would say to sit back and actually look at what you need the money for and why you're doing it, because really what you want to be aiming to do is give away as little equity in your business as possible. So, I guess get, scrappier and, hustle a bit more and just seeing how you can get together a product yourself, just using tools and try and get some traction with an MVP. And then if you get to a point where you actually need capital to scale or there's something holding you back, then that's the time to go. But being able to demonstrate that you went away and built an MVP yourself without raising money and were able to get around, if you don't have technical capabilities, it's going to be a really strong signal to investors when you go out there. So, it's the thing I've noticed recently, and there's still a lot of founders out there that are trying to raise money to build an MVP, and it's not really necessary for a lot of ideas these days. So I would say don't just assume you need capital. Sit down and think about what it is you're trying to do and how can you do that without raising any external capital.
Thanks, Tommy. Yes, Oscar, it's your turn.
Okay, great. So the first thing I would do, and this is really critical, I would really, really take time to understand your financials, whether that's your business plan. You need to be in the detail, every single line on your P&L, your gross margin, your EBITDA margin, everything from your cash burn. We see so often founders are not in the detail with their financials, and you would not give somebody a Ferrari unless they knew how to drive. So why would you give someone £4 million if they're not in the detail of their financials? VCs will not back people just on product or just ideas anymore. So do spend time to understand your financials and do have a clear rationale for why you think you can achieve what you say you will achieve. Secondly, do figure out whether venture capital money is right for you. Venture capitalists do not want a 2 or 3 or 4x return. They are only interested in opportunities where they can shoot the lights out and do a 10x. So there are many opportunities for you guys to pitch to less aggressive investors who will put less aggressive terms on the table. And often I see examples of companies which are not really a fit for venture, but they'll be a fit for other types of investors. Don't take debt if you really can avoid it at an early stage, and don't dilute yourself too much. Typically, you should be aiming to have 80% ownership at seed stage and about 50 to 60% ownership at Series A. If we see heavily diluted founders, it makes the investment decision much, much, much harder. We want you guys to be fully incentivized. And where we see Series A founders with 15, 20%, it does make it very difficult. Even though we'll give an option pool, it makes it very difficult for us to get excited because we think the founder needs a lot of upside before we give him or her the money.
Okay. Yeah, down here, I'd say, first of all, remember investors are human, but what they're really looking for is to invest in the people, not just the technology and the vision of what that business is going to go, where it's going to go. Technology, you're selling a business, and the financials and the whole exit is really important. Go prepared, be prepared, be clear what your problem is you're telling, your story, your solution, your market, the traction, the team. Go out only to investors when you are ready, and make sure you know who those investors are and what's going to interest and what's going to float them. Don't spend your time going out to investors if they're not relevant for your sector. Wherever possible, show traction, make sure you understand who your customer is, you understand the business model, the challenges. Investors don't mind it if you've got challenges, as long as you're aware of them and you've got some kind of plan to mitigate them at the end of the day. Build relationships really early with your suppliers, your partners. Show that this is a business, not just a small team huddled around. And do your due diligence on those investors as well. And yeah, and know the terms. Go in. You're in negotiation from day one on what your terms are, how much you want, what your valuation is, and the kind of things you'll be able to compromise with, and figure out who when you're going out to investors, is probably going to be your lead investor and who's going to be suitable to follow on, and try and hustle and work through that as well.
Yes, Antonio here. I will add that you need to take into account that fundraising is a long journey. So don't try to raise money when you are 2 months away from basically closing the venture, because most investors won't be able to join, and won't be even willing to join if they know that if they don't put the money in, the company is basically going to be closed shortly. I would stress to keep doing a lot of due diligence on the kind of investors that you want to bring on board. Why do you want them, and what are the value added that they can bring to your company? It's generally at early stage is very difficult it's generally easier to raise a larger ticket, because investors know your business, you have some traction, you can show them something, than raising like a $500,000 ticket, because in that case you don't have a lot of things to do. So, or as all the other panelists already said, try to get prepared, get to a meeting where you can show something, or you can show your kind of an MVP. You can show traction in terms of customers. You can show that you have managed to build up a team, even if you don't have the money to pay the team, but at least you have some key figures, either on the advisory board or within the founding team, that can address the issues that you will face in the months that are in front of you. Don't try to spam investors just for the sake of getting money. As I said before, do a lot of due diligence in terms of the kind of people you want, but also in the kind of investments that they make. If you're raising $500,000, don't go to a fund that will invest a minimum of $500,000, because most likely that fund you are definitely too small for them, and so they won't put the money in. Try to move. The UK has a very friendly investment scheme, so try to get your EIS and a CIS paper advance assurance as soon as possible, so that you can show them to your investors, and try to get the angel money at first, because they are less aggressive, and that you probably manage to give away a little bit less equity and be stronger for future rounds.
Thank you very much for that, gentlemen. That was some brilliant gold. Really appreciate that. Okay, I think we now can go to get some quick questions. For those of you that are already here on Microsoft Teams, all you have to do is just drop your questions in the chat. We'll then give you the mic and you can ask the team. For those of you that are on the live streams, LinkedIn, YouTube, Facebook, or Instagram, simply go to either click on the links that I've shared on those live streams, or simply go to our website, startuptoscaleup.club. Click on today's session, which is Startup Fundraising Q&A 142. Click join. It's a quick registration. That gets you a link to your email. And through that link, you can join us here on Microsoft Teams. It's audio only. And once you're here, you can then, once you've dropped the question, we'll give you the mic and you can ask the team. So we'll go to our first question. This is a predictive analytics platform for retail supply chains in Leeds, pre-seed. And the question she asks is, as a predictive analytics platform for retail supply chains, we lack existing investor connections to get warm introductions. I don't know why, but this sounds familiar. I can't remember who was here last week, but if you were, please let me know in case I've used the same question that they said last week. How can we leverage UK-based accelerate? No, okay. How can we use? How can we leverage UK-based accelerators focused on supply chain tech or retail innovation for warm intros? Plus, would cold outreach through LinkedIn or angel networks offer meaningful results without those initial connections? And then, are there specific angel groups that tend to focus on supply chain tech and could be more open to cold approaches from early founders? It's an interesting one. There's quite a few questions here, but I guess the basic point is, do we know any good accelerators or any other means that we can get to investors investing in our field? And if not, what's the best way, like LinkedIn and so on, to do cold outreach? So perhaps we should start with Oscar, Antonio, and then Dan, and then Tommy, please.
Okay, so the first place I would start for this, if you don't have warm intros as your phrase, is Perplexity Pro or ChatGPT. And if I have just typed in UK supply chain accelerators brackets VC into Perplexity, it comes up with Catapult, Digital Catapult International Supply Chain Accelerator, the Crown Estate Supply Chain Accelerator, 150 million fund. So general business accelerators with supply chain, Bethnal Green Ventures, the Bakery, Founders Factory, Fuel Ventures. There are many. There are many players in this space. It just requires a bit of kind of common sense and a bit of hustle. Cold outreach, it absolutely can work. Pick up the phone, have a very good pitch deck ready to go. So a bit of desk research is your starting point, and I do think cold outreaches can work. I would add that retail supply chain and kind of predictive analytics for e-commerce, there are many players in this space already. So I think this will be quite a tough sale for a VC. I mean, we see a lot of these, and some of these now are already quite well scaled. And again, the big media agency holding companies, whether it's Publicis or Omnicom or WPP, a lot of these companies have developed this kind of solution in-house. So I would always be wary of the incumbents, but there are absolutely players. Put into ChatGPT and give it a go.
Indeed, and Oscar, just before we go to Antonio, if I remember correctly, you're a principal where you are, is that right?
Correct.
Yeah. Roughly, what would you say has been in the last fund? What would you say has been the share or percentage of cold outreach that you've actually ended up investing? Or is that?
I would say our cold
substance
outreach to startups has increased between funds 2 and 3. We now do cold outreach every single week. We'll do market mapping, and then we'll do quite a lot of trade fair attendance. We're a big believer in actually going to trade fairs to meeting the people straight up. But we will do cold outreach, and on a very competitive deal, I would agree, it's unlikely to yield any results, particularly where you have tier one investors involved. Where it's a less competitive round, or even if it's off cycle, i.e. the company is not raising, often you get a result and you do get at least a conversation. And once you have a conversation, you've got a relationship, you then follow up when that company is raising. So I would say increasingly we do use cold outreach to attract founders. Yeah.
By the way, I didn't mean to put you on the spot. I just trying to get an understanding more than anything else, because your cold outreach, and I'm seeing quite a few VCs that are doing that, and I'm actually really pleased about that. That, you know, a lot of VCs are understanding that they need to get out there. But the other way around, what I see when it's the other way around, unfortunately, and this is only my experience, by the way, that hasn't been really successful lately. Although I do know, and I've come across just in the last few weeks, at least 5 deals that they literally reached out, called, but like you kind of insinuated, they kind of built a relationship with those VCs first, and then eventually they ended up investing in them. Antonio, sorry, go on, Oscar.
So final point is that, I mean, I get inbound nearly every day. I've actually had 2 today, and the going in kind of assumption of VCs is that if you get inbound on LinkedIn, it's crap. That would be the assumption, because usually VC in London is a very small world. Usually hot deals in specific spaces are shared, are talked about, are spoken. There'll be introductions between VCs. So usually inbound in your LinkedIn inbox is perceived as being poor quality as well, I would also say, even though it may not be.
Exactly. And that was the point I was trying to make. At least that's been my experience. And whilst I personally think that is not right, and that's how it shouldn't, and that's not how it should be, I guess that's the name of the game, and we can't dictate those. But Antonio, what's your input here on her question?
Yeah, I will start from the last sentence you said about the cold emails you get in the inbox or in your LinkedIn account. I guess it doesn't. You can reach out to funds or investors even if you don't know them. As Oscar mentioned, there are a lot of places where we constantly go on fairs or events, so it's very easy to approach, especially in London. It's very easy to approach a fund. But if you don't know or if you don't come across them and you just want to reach out to them, try to do it in a customized way. So don't go and get those massive list of investors and then just make one email and send them all to in one go. Try to go on their website or try to go on the LinkedIn page. Try to figure out if that person has an interest in what you're building, and try to be unique in the way you formulate your message. I mean, you are probably. I still read my the emails or the messages I get on LinkedIn, but when I see messages that start like, "Oh, this is a unique opportunity to become a millionaire," then that's not really something that I will keep reading. So try to be specific. Try to establish an early connection with the person that you want to have a chat with. So maybe, I've seen your post, or I've seen that you attended that event. We are building something similar to an investment that you already done. So try to establish a connection and then build on it as much as you can. And as Oscar mentioned, try to do it as early as possible. So especially if you don't need to fundraise, that's a very good moment to start fundraising, or start to establish those connections that will become useful in the future.
Yeah, I concur with everything Antonio said there. I mean, interesting. I mean, most of my deals historically have come from warm introductions, or from professional providers, accountants, lawyers, or other VCs. But it has to. I mean, I've always followed, always checked my messages, like Antonio, and gone through them. And I'd have to say, more recently, we've had some more success from cold intros from startups, and maybe that's because they've been listening to podcasts like this and the years that I've been on panels telling them to be more targeted and clearer on their investors. Because batch emailing investors does not work at the end of the day. If every one of those investors came back with a question, you'd have hundreds of replies to answers. So it's worth spending the time figuring out what kind of investor. Is it a family office? Is it a CVC? Is it a syndicate? Is it a crowd raise? Is it an angel, a high net worth? What kind of investment vehicles do they invest in? Do they have something is there a sector element to their portfolio, but maybe there's nothing competing with it? Is it the right geography? Is it SCIS? Spend all your time being quite data driven, because then you can spend your time focusing on those investors that you think are going to do it and really make it personal and build a relationship and really sell it. To answer the question that was put in the chat, by the way, in terms of supply chain investment is kind of bread and butter for a lot of accelerators and syndicates. Yes, there's a lot out there. So if you're very samey, it's not very good. But supply chain can mean everything from freight forwarding to marine to freight. So it really depends what you're doing. I guess the one thing I would say is, if you're in Leeds, maybe look at like Northern Powerhouse Fund 2. You're in that catchment area in the Yorkshire area, for instance. So there are, for instance, specific kind of angels within the Yorkshire area, for instance. So you've got Leeds Angels, North Invest, and various others. There's an angel hub there. Maybe target locally to use them as their kind of jumping spot to everything else. But equally so, there's plenty of accelerators out there. Your Techstars, which I mentor for, always runs, bread and butter stuff is kind of those in supply chain, Seed Camp, Founders Factory, Bethnal Green Ventures. They're all fairly familiar. Eagles Lab will be able to point you in the right direction at the end of the day. But make sure you're doing something unique, because it's a popular space, it's a big space, it's a massive market, but you don't want to be doing just another, predictive analytics company at the end of the day.
Yeah, I don't really have anything to add. I think the other three guys have, covered off pretty well how to go about this and approach the cold outreach. So I guess we'll move on to the next question.
Thank you very much for that. We now have 27 minutes to go. This is Startup Fundraising Q&A. It's our 142nd session, and we're here to help founders with whatever questions they have on their fundraising journey. There are no right or wrong questions, and there's no need to be shy. It's a learning curve for us all. If you're on the call here on Microsoft Teams, simply drop the question in the chat. I'll then give you the mic, and then you can ask the panelists. If you're on the live streams, just remember we're unable to monitor your questions there live, so you'll have to join us here. Quickest way to do that is to go to startup2scaleup.club, click on today's Startup Fundraising Q&A 142, click join. That will be a quick registration that gets you a link to your email, and then through that link you can join us here. It's audio only, which means you can join us from anywhere, whether you're changing baby nappies in Glasgow or cooking lunch in Liverpool or walking your dog in Surrey, whatever you're doing via any platform or device. We'll go on to our second question. This is a creative freelance platform founder, they're in Newcastle, pre-seed creative director. We're building a platform to connect freelance creatives with project-based work opportunities. The challenge is determining the right valuation for our pre-seed round without current revenue. What benchmarks should I use to justify valuation, and how do I manage investor expectations regarding future monetization? Okay, stop whatever you're reading or doing, or LinkedIn posts or movies that you've seen. Forget about valuation. Focus on what you're working on, because what you're doing is pretty much what it's doing. Platforms are so yesterday. There's nothing wrong with them. You can still make do, but focus on getting some traction. Forget valuation. But if any of the chaps on the panel want to add anything, let's start with probably Antonio, Dan, Tommy, and Oscar, please, if you've got anything quick to add here, fellas.
Yeah, I mean, I would add that when you start, I mean, it has been said before, but you are building something new. You are building something for which you need money, and to get that money, you probably need to gain the trust of your investor. So at the very beginning, the valuation is not that important. I mean, what you need to do is to build a story around what you're doing that will justify whatever evaluation you want to give to your company within obviously a reasonable bracket. So at the very beginning, you need to figure out, you know, how many years you want to, how many rounds you want to make in the future, how you want to create your company, how you want to scale it, build all the stories, all the elements that will allow you to have a strong story, and then you can go and ask for money to an investor. At that stage, you also come up with a relatively clear idea on what is the valuation that you want to give, and then by obviously discussing with your investor, you will probably find the right around the right number to lend. So it's just a matter of doing the homeworks and doing it very thoroughly.
It's Dan here. I'm a big believer in understanding what you're worth, particularly when you're negotiating with an investor. Better you go in with a valuation that has been, you run the numbers, than them suggest, then because whatever valuation you go in, that's the one they're going to try and reduce. You never get screwed. If you're a good startup, you never get screwed over on the amount of money you're going to get. You get screwed over on in terms of how much valuation you are. So better you justify your valuation and have it calculated. Pre-seed, it's really hard. I mean, the classic kind of M&A approach of discounted cash value, DCF, is really, doesn't work because you're pre-revenue, so you don't have any cash flow at the end of the day. But there are kind of classic ways of doing kind of some idea on what your valuation is. There's the scorecard method, there's the Berkas method, which looks at the strength of team, the IP, that kind of stuff. But you might also want to look at approaches which look for the kind of sector you're in and the expected multiples in that particular sector. So some certain sectors, like I know cyber, have a 12 times X multiple, for instance, EBITDA multiple and stuff like that. So there's various methods that are all available online. You can Google valuation methods, but don't go crazy on spending lots of time on it. Make sure that, I mean, the one good thing you're going to need before you do your evaluation is a solid set of financials. So a good 5-year projection, every startup does. And then it makes it far more a good market sizing. And that makes it quite quickly to plug those numbers into the calculators to figure out some kind of idea of what your ROI is to your investor. So use your valuation as a method to be able to sell this to the investor, that this is the upside if they invest. If you're doing pre-seed, you maybe were going down a safe note or like a AASA or some sort of convertible loan note where valuations are less important, because that kind of comes out in the wash. You don't have to actually specify a valuation for a convertible loan note at the end of the day. So, but it's always good to have something in mind.
Thank you, Tommy.
Yeah, so just, I guess, a few points have been discussed already, but I'd say just for this specific idea, it's probably going to be quite hard to raise capital at all, at least until you've got some traction and you prove it works. So I think you probably need to figure out how you can, self-fund building the platform. And, you should be able to build, as I've said already earlier, that, a basic version of your platform using tools like Replit and things like that. But, you're going up against, these marketplaces exist already, like Fiverr. And I just think it's going to be hard to find investors willing to back something that's going to be largely the same. And also, you're looking at other platforms are actually moving to having their own creator marketplaces, like TikTok Shop. You can go and find creators on there, Canva have creators. So a lot of the actual businesses out there as well actually, have their own creators on there who can either be reached out to, or people could put out RFPs for projects, things like that. So the space is very competitive, so I think it'll be hard to raise early stage capital for this. So I think you maybe need to think about how you can get an MVP out there and build some traction before you think about raising any capital.
Thank you, Tommy. And last but not least, Oscar.
Just last points on valuation. Valuation is really set by the lead investor. Founders think it is kind of set by them. They'll give an indicative view, but really it's set by the lead. And what I would say is that it's very important to understand the instruments that the venture capital investors can use. And if you want a juicy valuation, and by that I mean 10 to 30 times your ARR, you will expect some kind of liquidation preference to be applied. So do your homework, understand what that means. And it feels like in this market, you can either have a juicy valuation with structure applied, or you can have a lower, more sensible valuation, but with a much cleaner structure. So you have to figure out what works for you. And I'll give you an example of negotiation that we're doing at the moment to make it real. It's a business in Germany with 1.6 million of ARR. They have a term sheet on the table to lead a round at 10 times, so it's 16 million pre-money. They're raising 4 million, so 20 post. We've made them an offer at a little bit less than 16, 12.8, but we've thrown in a ton of founder options, which are kind of drawn down if they hit certain milestones. So we are doing a classic example of giving them less valuation up front, but we're going to give them more in the long term if they hit their milestones. And it seems to me like they will go with the other investor who are giving them less dilution initially, but it's a very good case study of kind of negotiation. So my summary would be, if you go with a crazy valuation, you'll get a lot of structure thrown on. If you go with a less valuation, it will be a much simpler and more straightforward structure on the deal.
And that's if you thought raising VC money was simple. Thank you very much, gentlemen. That is really good and useful. Okay, Pranash. Again, first of all, please forgive me if I've mispronounced your name. Is it Panache? How do you pronounce it?
It's Panache. So you're
Panache.
pretty close. Yeah.
I'm sorry. Please quickly introduce yourself and then fire away with the question that you've put in the chat.
Okay, thank you so much for giving me the floor, and thanks to the panel. This is a great discussion. I'm Panache, and I'm an early stage founder, and I'm the initial founder of our organization with some key members that have joined me, really supportive team, and I'm very proud to have them on the team. And I just want to make sure that we are, putting our best foot forward as we build our company. So I want to know from VC perspective, and like from you guys and your perspective, what specific patterns of interaction you look for between co-founders that signal they can navigate high stakes conflict. And as well, as I navigate the equity between, me and the founders that came on, I want to know what you think would be best so I can keep them motivated and see, long-term commitment there.
Can I just ask one quickly, one nuance? I would like to know before I answer this, why have you asked that question?
Like I said, I definitely want to make sure that we're going forward with the best foot forward. We're just starting out. All the vibes are great, but I'm the kind of person who wants to make sure I'm doing the due diligence for the future as well. So I want to keep them motivated, and this is kind of my first go at equity distribution, and I want to keep everybody motivated, but also being realistic about where we've joined on this journey. But it's pretty early on, so I mean, I'm happy to have like close to equal, but I just want to know what the advantages and disadvantages are there as well. I hope that answers your question.
Oscar?
I'm afraid, Prashante, you said an awful lot there without saying very much at all, if I'm honest. It feels like when you say the pattern of behavior between co-founders, it feels like you might not be sure with the decision you've made in terms of who you started your business with. You're worried about their motivation. When you have the opportunity to distribute shares, typically co-founders will have a fairly similar proportion, hence the word co-founder. And when you distribute shares to your team, I'd be very careful of giving more than about 5% to one individual person from an ESOP. And I would also make it vest over 4 years, so they accrue 25% a year over 4 years. That would be my advice. But it does seem a worry that you're starting out and you're already worried about kind of co-founder dynamics.
Thank you very much, Oscar. Let's now go to maybe Tommy, Dan, and Antonio, please.
Yeah, so I guess from an investor perspective, they're going to sit down with you and your co-founders, and they're going to speak to you together. They're going to speak to you individually, and they're going to want to know how you met, how long you've worked together, what the dynamic's like now. And I guess, you know, if you've known each other for a number of years and you've worked together at other companies or you've done other stuff together, they're probably going to be more comfortable that you've, you know, been through different situations before. And, you know, the last time you've known, or if you've, you know, gone out to find a specific co-founder and you don't know each other, you're probably going to go through like, you know, a proper interview process, like if you were interviewing for a job, and they're going to want to understand, you know, they want to know this stuff anyway, but really get deep on how you've dealt with conflict in other roles, and, you know, how you've got on working with people or for people you didn't agree with and managing situations. So you'd probably go through a process like that. And, you know, depending on who the investors are and how much they're potentially investing, they may as well lean on their network to actually, you know, have you meet other people that are probably specialists in trying to grill people and trying to pick up traits and ideas. So, you know, if there is concern about it, you know, the process, like there's no one answer. It's, you know, different for different investors and depends on the situation. But like you could have to go through a pretty rigorous process of getting grilled to just understand, you know, your personality and how you operate, and the same for your co-founders to try and see if they can identify, if you haven't known each other for very long, traits in your personalities where they think it's likely you are going to clash at some point, and do you think they'll be able to work through it. So it could be pretty rigorous. And I mean, all you can do is try and present to investors why you are working with your co-founders, why you've come together, why you think it'll work, how it's working so far. But, you know, as Oscar's asked there, if you have any doubts now, you probably need to try and sort those out before you go and start looking for investors, because they will unpick this stuff and they will kind of get to the bottom of if there's some conflict or you're not sure about stuff already. So I'll try and get your house in order before going to speak to investors.
So,
yeah.
Sorry. So Dan here. I mean, for me, get the foundations put in early pretty quickly. Beyond pre-seed, most startups fail not actually once they've had their first small round of investment, not because of lack of funding, but actually because of fallouts between the co-founders at the end of the day. So it's typically normal for co-founders to have equal shares. But whatever you do, make sure you put in a good founders agreement. You can get founders agreements online. You can download them, which really clearly articulate what the share is and that you're agreeing with it. I mean, classic examples, for instance, are, well, you know, if you look at companies like Apple, for instance, Steve Jobs and Steve Wozniak had equal shares at the end of the day. And, you know, but likewise, you could say, like in Microsoft, for instance, Bill Gates had the majority of the shares, about 60% compared to Paul Allen, and they kind of fell out eventually. So, you know, I mean, it can work that you have a co-founder who has less shares, but that might be because they're doing half the work, or they've come in at a later stage and joined as a co-founder, and it's quite transparent and agreed. But if you see sensing friction at the end of the day early on, investors will pick on that, and it makes you very weak for investors. Will immediately wanting to understand the dynamics between the team, that everything's collegiate. And yes, the CEO always ends up probably doing a lot more of the work at the end of the day, but you've got to remind yourself you're probably not going to be anything without the COO or the CFO. So, you know, wherever possible, try and give equal shares, or at least put a structure in place that you know, they can, if they are going to change later on, that there's some meaningful way to be able to do this in the share structure at the end of the day. Don't, you know, it's worrying you ask this question, because it suggests to me as an investor the dynamic's not right, and therefore if I was to, I'd be quite wary of investing if it's so early on, given you so early on, to be honest. So get it right and get it agreed. Be transparent at the end of the day.
Thank you very much, Dan. And last but not least, Antonio, any thoughts on this?
Yeah, I mean, I agree with everything that's been said so far. I mean, we invest at seed level, and this problem is still very actual when we start investing. So even after you've done maybe a little a small raise with a pre-seed, and you've been like a year and a half into the company. We generally like to look at companies as soon as they finish their pre-seed round, and we still find a lot of situations where there are conflicts and people don't know how to deal with this kind of conflicts. It's a very difficult business to run a company, especially with very few people in it. So, and bear also in mind that investors have see projects every single day, so they know the best case and they also know the worst case, and it's very easy to spot whether you fall in one bucket or the other. So, as an advice, it's not too late to reshuffle your team if that's what if you fear that they won't be committed, or they won't go they won't follow you, or you don't have that kind of harmony that you need to tackle a big venture like creating a startup. So it's never too late to take a step back and reshuffle the team if you don't feel confident with the rest of the team.
Thank you very much to all four of you gentlemen. Really appreciate that. Panache, I hope you found some solace in that in their answers.
Yes, thank you very much. I actually have really talented people on my team, and I'm very happy with them. I'm just, trying to have, like you said, understand the best case, worst case scenario. So these answers really are helpful in continuing to think about that, and just being wary of what different situations may arise. But I'm pretty happy with my co-founders right now. I want to make sure that everything is above board, like you said. So definitely we'll implement some of the suggestions you had here. Thank you so much.
No, you're very welcome. I'm guessing you just want to be about 5 steps ahead of the curve, so that's fine too. And thank you very much for joining us. Wishing you the best of luck in your venture, and please do feel free to join us again. We'd love to hear a bit more about your business next time. Okie dokie, we've got 7 minutes to go, which means we probably have time for 1 or 2 more questions. If you're on the live streams, LinkedIn, YouTube, Facebook, or Instagram, unfortunately, we can't monitor your questions there live. So you need to quickly go to our website, startup2scaleup.club, find today's session, which is Startup Fundraising Q&A 142, click join, quick registration, gets you a link to your email. Through that link, you can join us here on Microsoft Teams. It's audio only, which means you can join us from anywhere you are, and then you drop your question in the chat and we'll give you the mic. There are no wrong questions and there's no need to be shy. Now, a question, and I put that in the chat for the team here to see, but I'll read it out loud for the live streams. We're a home health monitoring. I'm a home health monitoring founder in Belfast, seeking to go directly from bootstrap to Series A, and I'm a health tech specialist. We've developed a home health monitoring system and are looking for Series A funding. Investors are questioning our exit strategy and potential acquirers. What should I include in our pitch to showcase viable exit pathways and strategic partnerships? Wow, okay. I'm not a huge fan of this. I see a few founders being quite hooked on what they call their next stage that they're going to raise. But I do understand that some people have certain reasons for that. Nevertheless, let's hear quickly from the chaps on the panel here. So we can start time with Dan, and then Antonio, and then Oscar, and then Tommy, please.
So investors will want to know your exit strategy, because if this is how they're going to get them, make their money at the end of the day through your exit. So it's really important to articulate what your exit strategy should be, and that will come down to what the board or the co-founders they may want to be living and growing and manage a company and be on the board and stuff. That might be play to their skill set, but they may then again be only suitable at starting or scaling a business. But it will also come back to what's the best interest for the company, and that will be a board decision, which maybe involves the shareholders. There's obviously various routes. There's kind of acquisitions, IPOs, which are back in fashion, by the way. I was at the stock exchange yesterday, where we're back into IPO territory now, and I suspect we'll go after a rather dull period. It could come down from a secondary sale, for instance, when you sell your shares as a founders to another investor. At the end of the day, it could be a management buyout. The only other exit you don't want to do is kind of like liquidation, so to speak. So figure out what plays to your strengths and the company's strengths. Clearly articulate that. You can never predict what's going to happen at the end of the day, because a great opportunity may come that you hadn't expected, but it's good to give them an idea of what's likely, particularly given the sector you're in, and how you can realize the most benefit for the company and your own personal value at the end of the day.
Actually, you mentioned the stock exchange, Dan. They're soon launching Pisces, which I think is going to seriously disrupt and revolutionize the private equity system for early stage in the UK and worldwide, for that matter.
Yeah, Pisces will give the UK stock exchange an opportunity to be more flexible and a lower cost, and hopefully without some of the burden of some of the other mechanisms. So for mid-stage particularly, and a scale-up kind of stage, who want to go, it should be a massive difference. A significant difference. We'll see a lot of time and effort's being put in this to make the IPO a lot more straightforward. Currently in Europe, UK is still the biggest place for IPOs, but we're starting to interestingly see some of the US companies look to Europe and other markets, because things are getting quite complicated elsewhere. So yeah, but IPOs one way, but IPOs are very costly. Usually something that you don't start thinking about. You might be thinking about it, have it as an exit plan, but it's something, it costs a lot of money to do an IPO, and anyone who's end up with a lot of grey hair if you go through that. But it's something that you might be wanting to consider in the future.
Indeed. I think we said Antonio, then Oscar, then Tommy, please.
Yes, I will don't get hooked up on how you call your funding round. If you need, it really depends on what kind of business you are trying to build. So if you need 5 million to create your company, you have bootstrapped so far, and you need a 5 million raise, you need 5 million. It could be a pre-seed, it could be seed or Series A. It doesn't really matter. In terms of what you should do, I mean, first you can add. For example, if you are in the healthcare space, you can also check if there are competitors or companies that have done something similar, or in another sector within the healthcare industry that have already made an exit, and you can tell, you can showcase, the number of rounds, how much they raised, and the exit that they have done. Same thing, even if those competitor haven't done an exit yet, you can still showcase how much they raised, and try to show that why you maybe they are in the US market and you can tackle the European market, and therefore you can show how the company can grow in the next few years. And in terms of exit strategies, if it's something in the health industry, you have plenty of companies. You can research which pharma companies are doing something within the space that you are tackling, and maybe potentially try to establish some connection with them, and see whether they get some feedback on whether your solution could be interesting in the long term as a potential acquisition.
Thanks, Antonio. Oscar, please.
Okay, I'll be quick. If I were you, I actually wouldn't worry about your exit options right now. I would focus all your energy and effort on execution. And let me tell you this, if you get the numbers, your phone will ring. In any industry, if you can show you can execute and you can build traction, your phone will ring. And your phone will ring from PEs, from strategics, from multiple options. And I think it's already been mentioned, but you should know your exit options as the co-founder of this business. You should know that already. And finally, I would say, if you do want to really obsess over the exit options, go and spend some time online and look at market comps, both public and private, and you'll be able to get a sense of how your companies trade and what valuation you can expect. But I would focus all about now on the execution, and when you get the good numbers, your telephone will ring and you'll have no problem having an exit at all.
Here, thank you very much. Tommy, any thoughts on this?
Yeah, I would say, to go and just do research, like just Google home healthcare device acquisitions. Like there will definitely be deals in the US that have happened, mergers and acquisitions in that space. And, a likely exit for you is probably acquisition by a larger, health tech devices company, or a private equity buyout. But there's definitely transactions in that space. I don't know it super well, but I'm sure you'll find some examples. And M&A is probably your most likely exit. I wouldn't, but if investors want to see what your thoughts are on that, then put together a slide. I wouldn't waste too much time, because if somebody's going to write you a check for a Series A round, they probably want to be doing that work themselves to understand what they think the exit opportunity is for the business anyway. But I will say specifically as well, because you're based in Belfast, there's a company there, and you may well know them already given you're in the space, called Be Secure, that have developed heart health and heartbeat monitoring systems that they sell into other device operators in the US. So they've got some pretty big customers that actually use in their devices, use their actual heart monitor technology. So they know the space super well. Have been around for a good while, and they're really impressive. So I would, it's a small tech community in Belfast. I would reach out or find somebody, if you don't know them, that is a mutual connection, and go and speak to those guys, because they know that space super well. They know the device space and health tech. So I'd go and actually just speak to them. You must be down the road from them, and they will, I'm sure, be happy to meet you and tell you a bit more about it, and give you a bit more of a view of what it might look like for an exit for your type of device.
That's brilliant. Thank you very much to all four of you, gentlemen. We are now 2 minutes over the line, so I wouldn't be too upset if you need to run. But if you don't, how about some parting words? Let's start with Antonio, Oscar, Tommy, and Dan, if you've got time for some quick parting words, please, gentlemen.
So try to be always yourself. Try to show the passion that you have put in creating your company, and show the courage that you have to make it grow into a big venture, and obviously in the long term make money to all your investors.
Thank you very much.
I would just say that being a founder is really, really, really hard. It's long hours, it's exhausting. You need to be obsessive to be successful. Keep hustling. Best of luck. And I would also say that if you are not aiming for a business that's going to be a 20x or a 10x, that's totally cool. If you want a smaller business that's going to grow slower, that's very respectable. And VC in that case is not the right funding route for you.
Here, thank you very much, Dan.
Yeah, I guess I'll part with some reflections on this podcast, where we've had some great questions in different areas. It's always good to ask questions. You should want to get mentors and expertise, and you should constantly ask questions. I guess the one thing to say is there is a lot of information out there publicly available on the internet, on channels, on webinars and stuff like that. And I would say a lot of the questions, I guess, that you got asked today, you would probably find a lot of information publicly available. So spend some time. It's grilling. It's painful doing your research on this, and and use opportunities like us to verify it more than anything else, because you'll find a lot of information is out there. The VC sector has been going for hundreds of years, and only so much has changed.
Thank you very much to all of you, gentlemen. Thank you to everyone that tuned in today, but especially to those that did it directly here via Microsoft Teams rather than on the live streams. Before my parting words, we run 6 regular sessions: Mondays talent, Tuesdays product and tech, Wednesdays growth, and Thursdays, as you saw today, startup fundraising Q&A. On the second Friday of each month, we do a session on UK startup law, and on the third Friday of each month we do a session on UK startup finances. They're normally all from 12 to 1 p.m. UK time, and you can RSVP to any future session via our site, startuptoscaleup.club. When you go there, you'll see a list of future and past sessions. If you click on the future, you'll be able to register for any of them. They're all live audio, which means you can tune in from anywhere via any device or platform. And by the way, when you go to our website, you may also want to join our community of, we've got a WhatsApp community with groups of founders, investors, and operators, and you can do that when you're on our site. At the top and bottom of the site, there's icons there. As far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime and be kind to yourself and everyone else for that matter too. Otherwise, you have a great weekend. Hopefully we'll see many of you at London Tech Week next week. We'll be there, and also we're hosting all our Q&As, all 6 of our Q&As as flagship, as our flagship Q&As as official fringe events. And you can join them all. By the way, the only difference is that next Friday, our legal Q&A will be at 11 a.m. and our finances Q&A will be at 2 p.m. So if you do see any of us, quite a few of our panelists will be there. Just say hi. Otherwise, again, have a great weekend and God bless you all. Bye-bye for now.